It's your boy Crypto Blood, and welcome to another My 2 Cents episode. Today we're looking at, I thought, the end of the year was a good one for the Fed. They were able to slide through unscathed, no real drama from the repo markets, but it's a new year, new problems, I guess. Repo panic returns. Fed injects almost $100 billion in liquidity, $99 billion to be exact, and it looks like things are heating up again. Top repo expert also warns of Fed being in a trapped position now and that it will take pain to wean the repo market off of easy cash. So that's what we're looking at this morning. And I'll give you my 2 cents on the situation here in a second. But before we start, if you guys find these types of videos informative, make sure you like, share, and subscribe and click that bell to receive more videos like this. Dow Jones hitting another 52-week high intraday. Amazing. Didn't close at its high, but nearly at its intraday high, which was almost $29,000. Dow Jones will be at 30,000 within a blink of an eye if you ask me. It's kind of a complicated situation though, since we have the repo market starting to heat up again. Can the Fed hold it together for yet another year, at least to get through the end of this year? Because, Trump's campaign is about 80% based on a stock market making all new highs. His messaging is that a better stock market means a better economy, and that could be no further from the truth. And as you guys can see here, there was a knee-jerk reaction from the drone strikes and retaliation from Iran that happened yesterday. We saw a spike in crude from those events, touched all the way up to $65.50, but has since faded. Same thing with Bitcoin as well. As you can see, we had a nice rally coming off the news of the Soleimani drone killing, but has since pretty much faded and almost back to where it was prior to. So markets are definitely reacting to what's going on in the Middle East. But what about what's going on in the repo markets? Even senior contributors over at Forbes are saying this is getting out of control. This one contributor, John Maldine, says that the Fed is creating a monster. And he concluded in this article that coordinated monetary policy is actually the problem, not the solution. And while he has little hope for change in that regard, he also has no hope that monetary policy will rescue us from the next crisis. To amplify the last line, not only is there no hope for monetary policy that will save us from the next crisis, it will actually help cause the next crisis. The process has already begun. He predicts an unprecedented crisis that will lead to the biggest wipeout of wealth in history. And most investors are completely unaware of the pressure building right now. Of course, they're not aware, because if they were, the price of these markets would reflect that. Right? So you're not in a crisis until you are in a crisis, essentially, is what it boils down to. So, if you're invested in these markets, you don't want to react. In this case, you want to be proactive, because while things are calm is when you want to get your ducks in a row and your house in order, not after the fact. After the fact is too late. And so this article from Bloomberg is talking about giving solutions as to how they can fix this mess that we've gotten ourselves in, or I shouldn't say we, more so the Federal Reserve. And so one of the answers to a question posed in this article was the question about liquidity, and is that the only issue that we have? They say no. Powell and U.S. Treasury Secretary Steven Mnuchin have focused on a related issue, something called intraday liquidity. Before the crisis, banks were allowed under some conditions to run daylight overdrafts in their accounts with the central bank within the course of a day to cover any gaps between big payments and settlements as they came along. But banks would then net out anything owed around the close of business. Over the last decade, the Fed has nudged banks towards settling those transactions as they arise instead of waiting until the end of the day. But this is causing a problem. So intraday settlement, some banks argue, means sharper swings in their reserves during the day, which makes it hard for them to commit cash elsewhere. A more flexible stance from the Fed on overdrafts might help at the margins, but it may not satisfy banks angling for regulators to lower their reserve requirements. So it's interesting to see this whole quote unquote daylight overdrafts being essentially phased out. The Fed doesn't want this to occur. But why? Why is that the case? There's something going on in the market that is forcing them to say, hey, we can't have you guys waiting till the end of the business day to close these or shore up these negative accounts. And so many of you may have heard the video that I talked about as far as the Fed being able to close out 2019 as a success in their books, because actually the last week they ended the auction undersubscribed, which means there was not a lot of demand for cash to float banks intraday. However, things are heating up again as the Fed injects almost $100 billion in liquidity including the first oversubscribed term repo in 3 weeks. And just like that, the repo market is on the fritz once again, more than 2 weeks after the last oversubscribed term repo operation on December 16th. Moments ago, the Fed announced that dealers are once again scrambling for liquidity, submitting $41.12 billion in securities into today's 2-week repo operation, which was oversubscribed, hitting the maximum operation of $35 billion. So what does that mean? That means the difference is going to be filled in by the Federal Reserve. It goes on to say the oversubscription was ominous because while the liquidity shortage into year end was expected and justified the barrage of term repos ahead of the turn, the liquidity shortage was supposed to normalize after the new year. That appears to have not happened, and today's submission was the highest since December 16th. Look at that spike from the term repo operations. But wait, there's more, they say. Today's oversubscribed term repo, coupled with yesterday's overnight repo surge and this morning's $63.91 billion overnight repo, means that the Fed just injected a total of $99 billion to keep the levitation party going, and confirms that the repo market remains paralyzed. Man, this is interesting what's going on here. Things are starting to heat up again, and top repo expert warns that the Fed is now trapped. It will take pain to wean the repo market off easy cash, he says. Scott Skyrim writes in his daily repo market commentary note, the total overnight and term Fed RP operations on Friday were greater than on year end. On year end, the Fed had pumped a total of $255 billion into the market versus $258 billion on Friday. So these injections, guys, are getting worse and worse. Look at this chart going back to September of 2019. Literally nothing going on all the way up until the 18th of September. And it just escalates and gets worse and worse and worse. And the blue area is really where we should be watching. Reserve totals and T-bill holdings continues to get larger and larger. The problem, it says, with the broken repo market and the Fed's respective repo operations, similar to the problem observed with QE and the Fed's balance sheet in general over the past decade, is that the market had gotten addicted to easy Fed liquidity unleashed in September and then again in October. And so Skyrim writes, it's easy to see how the repo market can get addicted to easy cash from the Fed when the stop out rates for the RP operations are 1.55% behind the offered side of the market. So he says, as the Fed continues to inject cash, the market gets used to it, which is great in the short term as it sends risk assets soaring, but become a major issue over the long term. The long-term problem is that some of the investor cash that was once going into the repo market is now going elsewhere. Indeed, the problem is that the repo rates are trading in the lower end of the Fed funds target. So what does this all mean? It essentially means that it will take pain to wean the repo market off of its cheap Fed cash. He said for the Fed to end daily repos, they need outside cash to come back into the repo market. For the repo market to attract cash, repo rates need to move higher. For rates to move higher, the Fed needs to stop repo operations. But the problem with stopping repo operations is that it could spark another repo crisis, especially when $259 billion in liquidity pumped currently, more than at year end via repo. So essentially what that means in programming, we call this a for loop. Where, the Fed is in an infinite for loop, and at some point the memory is going to get filled up and it's going to crash the program. They can't keep doing this forever, people. But again, I don't know, and no one knows when this is all going to fall apart. It doesn't matter. It hasn't fallen apart yet, so that gives you opportunity to make your decisions and plan accordingly. And so really my conclusion and the main question is, how long can the Fed avoid pulling this repo liquidity band-aid off? The longer they wait, the bigger the market will fall. The question then becomes whether Powell can keep pushing on the repo string until November elections. And that's really, to me, the end goal for the Fed at this point. They're just trying to keep this market up, and it's their duty. They say they're an independent entity, but ultimately they're working for Washington and Wall Street. That's their dual mandate, nothing else. They say it's full employment and whatever other made up mandate they have, but ultimately it's Washington and Wall Street. This is who they have to appease, and this is who they serve pretty much, not the people. And so it will be interesting to see after the elections and I think Trump will be reelected, but after the elections, either way, Trump in or out, it's best that he doesn't get reelected, because at that point, I think the markets will really take a tumble. And as I stated before, Trump has run and put all of his campaign on the fact that the stock market is at all-time highs, which he then equates to the economy doing well for the everyday person. And we know that's not the case. But hey, that's just my 2 cents on the subject. Let me know yours in the comments below. If you found this video informative, make sure you guys like, share, and subscribe, and click that bell to receive more videos like this. I'm out of here, people. Holla.